Welcome to the October 23rd, 2023 Advance Report for McGowanGroup clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, with your weekly fast-paced tour of the global financial markets. I'm President, McGowan Group Wealth Management, a team of 10, the team that cares, evidenced by the fact that we do this for our clients every week, deep research that you can't get anywhere else. Be sure to subscribe and share it with your family so they'll be better educated and y'all can make a big pile of money together. Here on the update for the clients, we had a week of drama. And I want to explain, there was a sea change somewhere in August. What happened and what caused the downdraft this week? You could see the Dow Jones Industrial Average was all happy back here in August, almost hitting 35,679. Now, we descended close to 33,000 at the lows of the week and finished about 33,200. That puts the Dow at break even. Remember that concept because it's important. Where did this pressure come from? Well, it's not earnings. I'm going to get to that. This week, the long treasuries, 10-year, 20-year, 30-year treasuries, the price got smashed. The institutions gave up on their premise that it's going to be a recession. They had been buying treasuries under that premise and no recession came. Retail sales, they rose twice as much as expected. GDP in the third quarter has been raised, the estimates, to almost 6%. That hasn't happened since 1984, at least for a full year. That's a wow. And it's a lot bigger than China's growth, by the way. That's in a world of hurt. You can get that podcast at Apple Podcasts. We talk about the Chinese world of hurt this week. Ooh, it's bad. And it has an impact on a lot of U.S. allocations on the international side, of course. Here, this is the Fed funds rate. So I'm going to cover the drama with the treasuries. So Fed funds rate is 5 1/3%. This is a historic increase because Jerome Powell and the Fed were all worried when inflation got to 9% after they printed $4 trillion. Wow, maybe they shouldn't have printed that much. And profligate government fiscal spending, over-regulation. Inflation peaked last year in the summer at 9%. Now, it's back to its more normal 3.5%, depending on what measure you use. Well, there's an important part to this graph, and here it is. They're at 5 1/3%. Inflation's already down in here. What gives there? And Jerome Powell this week, he said, you know, with the spike in the long treasury yields, that's going to do some of the work of slowing the economy. And at the same time, some parts of commercial real estate have gotten decimated by the rising rates on capitalization. They determine what you pay for a building. So what does the Fed really say in their projections? Between now and 2026, right? Think in terms of 3 years instead of 3 minutes when you're investing. Between now and 2026, these are the Fed governors and the board members and the presidents. Their projection is they'll be back to 2.5% on the Fed funds rate. What happens during that time? Well, stuff that pays cash flow, by definition, is worth more. You can use an Excel spreadsheet or Taylor's theorem, say what's the net present value of future cash flows. You divide by a lower number, you get a bigger valuation. And that has a big impact on the next 3 years because they've reloaded to historic highs, right? To go above this level, you got to go back to 2000. Mortgage rates are at a 23-year high. And they've overdone it, I believe. So they'll start to come back down. Every time they come down, that's actually good news for the markets. Now, what's this? This is the Dow. Back in 1994, the Dow was 3,600. Then it went to 36,000. That's pretty good. This was a very difficult time period. The tech wreck happened right here. You could see long flat periods. if we look at this flat period from 2020 till about right now, that is the 9th longest flat period for U.S. equity. And earnings just started to rise. So here we had 6 quarters where earnings declined or stayed the same. That's called an earnings recession. And that's really been since 2021, started at the beginning of 22. Now we're approaching 2024. Now we have about 1/5 of the S&P 500 companies have reported. Sales growth, 5.7%, that's okay. Earnings growth, 2.2%. Energy's 14%, leading the charge. Wow, what does that mean? It means that for the first time you're seeing earnings starting to rise. And Ed Yardeni, who's a great forecaster, he actually graphs his forecast versus what happens. He predicts by the end of 2025 that you'll have 20% increase in S&P 500 earnings. Wow, at the same time, Federal Reserve expects they'll be bringing the rates back to normal. That's a little bit better long-term picture. What's working right now? Well, let's get to it. This is the oil price chart. You can see the spike back over $90. Now, this was a retracement. It went up $30 from here to here. That was a big 4 months. Then you retraced about half of it. Why? Well, if you're an oil producer, you have a $30 spike, you want to lock in some of that with your forward production. And so it retraced about half of that. That's normal technically in commodities. Now, on Friday, why did we go above $90? Department of Energy, I'm going to call out some brilliance here with a little sarcasm. They said, oh, we're going to replace 6 million barrels of the Strategic Petroleum Reserve. Okay. Well, they sold hundreds of millions of barrels down at about $70. And now they're going to start to refill it at $90. So if I do that math, if I sell at $70 and then I repurchase at $90, that's some bad trading strategy there. I'll just point it out. But anyway, it means they've reversed. They've started to fill that back up. You're in undersupply. Consequently, this is Dallas-based Energy Transfer. Between 2014 and 2018, they quadrupled the number of pipes in the ground. From 2018 to 2021, they paid off huge amounts of debt, started buying back stock, and they started to raise the dividend again. And obviously with an 18% gain so far this year and a 9% yield, remember it's not a recommendation for your portfolio till you come down and get a plan. Well, that's a great example of what's working right now. What else is working? Here, this is Novo Nordisk, the diabetes fat-reducing drugs. We like medical dividend companies, and here you've got a nice spike, and they're finding out it has more benefits than just diabetes and fat reduction. Eli Lilly has the other one, but I thought you could use a lift today. You know, what is working at this point? Energy, the medical dividends are working, and we'll show you the entire model portfolio when you come down and get your plan with the team that cares here at the Crescent or by a Zoom call. Just go to networthradio.com. You can reach us there. We look forward to serving you and your family. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the Longer Play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.